The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
If you thought that jobs report would provide clarity on what the Fed does next, think again. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off to the closing bell here in the U.S. on this Friday. Let's take a look at where we stand. It's not good news for the bulls. The S&P 500 down about 0.4%. We got that very ugly jobs report earlier this morning. Tech trying to outperform here, trying to go green, not exactly getting there as measured by the NASDAQ 100, still about 0.1% lower. I thought this was interesting to see small caps outperforming. Actually, the Russell 2000 higher on the day, probably helped by what we're seeing in the bond market right now. I put up your 2-year Treasury yields right now lower by 8 basis points. Of course, traders really setting their Fed bets that this Fed is going to cut rates in just about 2 weeks' time. And you can see that probably lifting the small caps a little bit relative to the rest of the market, Romaine.
Yeah, that outperformance in the Russell caught me by surprise. We're going to talk about a potential surprise in the tech space when it comes to executive pay. But how about the magnitude of that labor market weakness that we got earlier today? It took almost everyone by surprise. The job market is cooling. That is now unambiguous. It's also clear that that cooling is gradual. But it's a gradual slowdown amid the backdrop of still persistent inflation, a core PCE price index that hasn't made any meaningful move lower in more than a year and has been above the Fed's 2% target for more than 4. The conflict of a dual mandate that leaves the Fed now with a very tough decision.
I want to get more information. I'm still undecided as we're going into this. If it looks like the labor market is deteriorating on grounds more than just the monthly payroll numbers, because I want to emphasize again, when you have population growth changing around behind the scenes, just the aggregate monthly payroll growth is not a great indicator of the business cycle.
Chicago Fed President Austin Goolsbee right here on Bloomberg earlier today, a voting member on the FOMC, and that will actually be the last FOMC voice you will hear until the monetary policy decision on September 17th. The committee now heading into a media quiet period to preserve the integrity of their internal debate and discussion, a debate that can't ignore the labor market weakness, as Goolsbee just said, but neither can it ignore the strength of price inflation. For now, Wall Street does remain confident that Jay Powell will steer the committee to put more emphasis, though, on the fraying job market, anticipating a 0.25 percentage point cut. But after that, well, real money wagers, they're all over the map, Katie, though we should point out the bias is still towards bets for a downside move through the rest of the year.
Absolutely. And this chart really neatly shows that. You can see in white, this is September pricing, 27 basis points priced in for this meeting coming up in about 2 weeks' time. So more than 1/4 point cut priced in. Traders not exactly willing to go all the way to 50 basis points, though that discussion has been reignited by what we saw this morning. But also, as you can see on this chart, it's not just September, it's October, it's December as well. In October in blue there, you can see that 19 basis points of easing are priced in. And then you get to December in yellow, 23 basis points of cuts are priced in. Of course, a lot can happen between now and those meetings. We have a lot of data to get through, but at least for September, at least after what we learned at 8:30 this morning, it seems like investors locked and loaded for a rate cut this month.
Absolutely, Katie. And we talk about how the market has reacted to that potential. You were kind of pointing out the at least something what might seem like a curious sort of outperformance by the Russell 2000. But again, we talk about the idea that at least if the Fed is focused on the labor market, that means more accommodative policy, and maybe that does help lift stocks. We should point out that the dollar is weak for yet another week. And then, of course, gold. I mean, we haven't really talked about that. We'll get that to later in the show. 3,600 an ounce at one point on the day. First time it's hit that level, as some people now seeking the safe haven. But that's also kind of a sign, too, that maybe inflation isn't as much of a concern for investors if they're willing to pile into gold at this point.
Yeah, those fears really translating into big demand for gold. What I find interesting, we've talked about it a few times this week, is that you have twin demand right now for gold and for Bitcoin. Yes. You would imagine that it could be the same impulse that is driving investors to those two different asset classes. But when we think about the rate picture, what I find interesting is that This feels very similar to where we were exactly a year ago. You think about that series of weak labor market prints we had in the summer of 2024. The Fed came out with a 50 basis point rate cut in September and then had to pause.
And I just have to ask a question about this. I know we're making a big deal out of this labor report, and it's bad. But there has been some people speculating that this might be maybe just sort of a bump in the road, right? The idea that there was a lot of sort of uncertainty when it came to tariffs and trade policy, and that maybe put a chill over the labor market and hiring. But now that we have some clarity as to where those tariffs are, and Trump is, at least for right now, articulated a little bit more clearly what that trade policy is going to look like going forward, maybe that emboldens a little bit of hiring. We should point out, though, Katie, a lot of other stories going on in the market today, not just with regards to the macro and rates.
That's true. Let's get to Elon Musk. Haven't talked about him in a while. We're keeping an eye on Tesla shares after the company proposed a new pay package for CEO Elon Musk that could be worth an unprecedented $1 trillion. Now, that offer is intended to keep Musk at the helm of the automaker as it branches out into AI and robotics, with a stated goal of bringing Tesla's market value to $8.5 trillion in 10 years' time. For reference, that's the size of roughly 2 NVIDIAs. Let's discuss with Ross Gerber. He is co-founder, president, and CEO of Gerber Kawasaki Wealth and Investment Management. Ross, one of the perfect voices to have today. Let's just start broad. What's your reaction?
I mean, my initial reaction was just humor. I mean, it's just, I mean, has there ever been anybody as greedy as Elon? I mean, the fact that he wants 100% of the market value of the company as his pay over the next decade to achieve fantastical goals that seem illusionary. I mean, the whole thing seems so crazy and out of control. I don't know. I mean, at what point are things just absurd?
Well, Ross, I mean, a pushback there would be that you think about the target they laid out, $8.5 trillion in a decade's time. Shouldn't that be rewarded on a big scale if he is actually able to steer the company to such a target?
Sure, it should be rewarded, but should it be rewarded with 10% of those market value gains, an unprecedented amount of money for any human being? At what point is the reward make sense? This is not about money. This is about giving control, 25% stake, to Elon, to obviously all these sort of fantastical market value goals and EBITDA goals are wonderful, and I hope they achieve them. I still own stock in the company, but I just think the entire situation is so out of control with a board of directors that can't even negotiate with the CEO. It's basically a hostage situation where it's, if you don't give me 25%, I leave, and then they just do it. And in a way that, in my mind, I don't actually think CEOs should be paid off market value increases. It should be paid off actual financial increases, and that's part of this pay package. So I don't know if he'll achieve any of it or none of it or all of it, but it's all just craziness at some point.
You know, I really encourage all of our viewers really to actually go out there and read the filing, because there was a lot of details in that proxy about how we got here. And it's interesting that you used the word, I think you had said hostage situation. This does appear like a situation where Musk effectively threatened to leave. And I guess it raises the question, Ross, of how important he is, not just so much to Tesla's potential future success, but how much of past success, and whether that in and of itself might have been part of the decision.
Yeah, and I think that's an interesting point in that, you know, when you look at Elon's past successes and you say, how important is he to achieve all these goals? And in one sense, you'd say, well, if you look at what they're trying to do, he's crucially important to achieve these goals, because it's basically his fantastical vision of pivoting you know, Tesla from being an electric vehicle company into some sort of robotics company, and assuming that there's even a market for these robots in the future, especially being made by a right-wing, you know, guy that probably a lot of people don't trust. So there seems to be a lot of elements to this that, you know, once again, if they're successful, he deserves some sort of excellent compensation. I'm all for maybe some reasonable number, but when you start talking about $1 trillion for one human being, you know, you start to say, is it really worth it? And could somebody else better lead Tesla in its original goal, which is sustainable transportation and energy? You know, what's wrong with that goal? And maybe they should just hire somebody to achieve the goal that Tesla originally was set out to achieve.
Yeah, and we should point out, too, I mean, also in that filing, they did talk about the idea of coming up with a succession plan for Musk. Doesn't sound like they have one, but certainly something that they've discussed. Ross, there's a broader question here, too. I mean, if we take at face value some of the proposals and ideas that Musk has put out there for how he wants to reimagine Tesla, that's all well and good. But as you know, there is, of course, a fiduciary duty for a public company to its owners, and that is that those are the shareholders, more or less, even if they are minority shareholders. Is there an argument to be made that instead of just giving him $1 trillion spaced out over the next 8 to 10 years, maybe just taking that $1 trillion and maybe taking this company private, and that way he can do what he wants with this company and would only have to answer to himself and whatever small group of people who help finance a take private?
Yeah, I think that's a great point as well. 87% of the people who own Tesla are not Elon Musk and have had no representation in anything that's happened at Tesla. And that's why I'm out here crowing all the time, is because I'm one of those people that feel that I have no representation on the board. And these people are not working for my best interest. They're working for Elon's best interest. I don't think it's ever been more clear from this pay package who the Tesla board of directors is worried about. They're going to take care of Elon at the expense of shareholders. And see, what shareholders, they might be happy today in buying the stock saying, oh my God, Elon can achieve this, we'll all make 8x. But what they're not factoring in is the actual cost in real dollars to us shareholders if he does achieve it.
Well, Ross,
it's quite high.
Well, to that point, I want to talk a little bit about the hypothetical scenario of what the cost to shareholders would be if Elon Musk wasn't in charge of this company. I mean, this is something that I think about a lot. What is the Elon Musk premium that has been built into Tesla stock? You take a look at Tesla's PE, it's somewhere north of 200 or just about there. Mm-hmm. You compare that to Ford, which is under 10 right now. I can't imagine that PE can be explained exactly by the number of cars that they're selling, as you would expect in a traditional automaker. The argument exists that if Elon Musk wasn't leading this company, that all of those shareholders who are so loyal to him would just back out.
Well, there's something to that. And I think that if you look at Tesla's true valuation minus Elon, and you assign a multiple, not to Ford, which obviously is not comparable to Tesla, it's more like Microsoft or an NVIDIA, which trades at 35 to 45 PEs. And even if you give Tesla the benefit and say, let's say a 50 PE with its current earnings estimates, you're looking at $150 a share over the next year. So you can extrapolate out that there's $200 a share of value. That's what I call the Elon Hope premium, and hopefully all these things will happen, and that's factored in on the stock currently. And that's why the stock would drop dramatically if Elon left Tesla, because there is a huge premium in the stock based off this hope. I think what it is over time, if you don't deliver, that's where this gets tricky, because shareholders are basically making an all-in bet where if Elon delivers, he gets a huge portion of the win. But if he doesn't deliver, shareholders take 100% of the loss. Yeah. So, it's a really unfair deal to shareholders. It's nice to put out lofty expectations that he may or may not achieve, but I think it should be done in some sort of reasonable number. Let's say 100 billion instead of $1 trillion, Yeah. Yeah. Am I crazy? I don't know. Sometimes I think I live in this alternative reality, but most humans make like less than $100,000 a year, and I don't think Elon's such an exceptional human that he deserves $100 billion a year pay package.
All right. Well, Ross, we have to leave it there. And I don't think you're living in an alternative reality. I think it's that the alternative reality is now sort of dominating the conversation. And I think some years from now, we're going to have probably one of the greatest Harvard case studies on corporate governance, or the lack thereof, that will explain 100%. What really went on. Ross Gerber, always love him, co-founder, president, CEO of Gerber, Kawasaki, Wealth and Investment Management. And of course, one of those smaller investors, if you will, in Tesla. We do want to get back to the other big story of the day, and that is the jobs report and what it means for the Fed's meeting. A rate decision expected in a week and a half's time, but a lot more speculation here about whether the labor market is going to continue to deteriorate and whether that will actually facilitate additional hikes down the road. Thomas Hoenig joins us right now, former Kansas City Fed president and now distinguished senior fellow at the Mercatus Center over at George Mason University in Virginia. Great to have you here, Thomas. I am curious here first about the debate heading into the meeting on September 16th, 17th. Jay Powell seemed to allude to the idea during Jackson Hole that they are going to maybe put a little bit more emphasis on labor market conditions. Based on what we saw today in today's jobs report, do you think that will dominate the decision?
I think it may very well dominate the decision. I mean, the Chairman Powell gave a pretty clear message that he was shifting towards concern over labor. The 22,000 number today was lower than some people had thought it should be. My own view is you're seeing some of the effects. You're seeing the effects of the tariffs. You're seeing a slowdown. The 22,000 is not terribly bad. It's not negative at this point, but it's low enough that I think the Fed, given his speech, is pretty much committed to a rate cut. Now, I say that, but I want to also point out in the report, over and over again, it said little change from July, much more stable from July. Many things haven't changed from July, and so in a sense, with all the adjustments that have been made, we're in somewhat of a steady state. In fact, the unemployment rate just went up from 4.1 to 4.2, 1.3%. So in a sense, you have that stability. And the chairman has an obligation, and so does the FOMC, to look also to the inflation numbers. And remember, inflation right now is 3%, well above the target.
That's where I want to go there. I mean, officially, that core PCE number that they focus on, as you obviously know from your time at the Fed, 2.9%. But more importantly, what I thought was interesting, it's been above the Fed's 2% target now for like 4 years. And I know the first couple of years of that really has nothing to do with the Fed. That was kind of the black swan. But even as it came down, it stalled out about a year and a half ago. And so you go back to the introduction of this 2% mandate in 2012 or when it came out here. Is that just off the table right now? Because how do they look at that and not say we need to do something?
Well, I think, yes, it's a very good point, because I think it's been 3%. They've been talking about how much it's come down, but it really hasn't come down in the last year to year and a half. And I think that is what they're doing is I think they're giving up some credibility on their inflationary targets. I think you have to remember also that it also signals that they may be accepting 3% as satisfactory, which I think is a big mistake, because 2% is not price stability. 2% is stable inflation if they were to get it there and keep it there. So I think they're risking a loss of credibility, and I think that's unfortunate. So I hope that they look carefully at the next release, which will come about the time of the meeting, and let that influence them, or the outlook of that influence them, because if inflation goes up, as I suspect it may, because remember, it's not just the tariffs that may be raising prices, but the recent budget bill that was passed was very expansionary. So you're going to have that increase in demand in the economy as well, which put upward pressure on prices. So they really should be very careful in how they thread this needle. It's much narrower than they're leading us to believe right now.
Yeah, it feels like that needle gets more difficult to thread with each single data release. I'd love to bring you into the conversation Romaine and I were having at the top of the show, that this really feels like September 2024. You had a summer of weak labor market prints. You had the Fed cut rates by 50 basis points in 2024 last September, and then they ultimately had to pause just a couple months later. Could you see a similar situation playing out in 2025?
I could. I mean, there's a lot of stimulus coming forward from this large bill that they just passed. I mean, there's a lot of subsidies in that. There's a lot of spending. There's defense increase, heavy interest payments due. That's going to put, I think, a lot of pressure on the economy in terms of inflationary impulse that they have to deal with. And so, yeah, I think it could happen. And we'll have to see, because if they lower rates and we see the yield curve begin to tilt up again, as it did last year when they did that, then the market is going to take the short benefit of asset price increases on the low end, but they're also aware of the longer-term risk, which I don't think the Fed should ignore at its own peril.
Yeah, definitely going to keep an eye on the yield curve, especially after the 2024 experience. I mean, from where you're sitting, how high is the risk of a policy error here? let's say that inflation does come back again in a meaningful way by the end of 2025. I mean, is that enough time to reflect on a September rate cut and say this was an error?
Well, I think it is. I think right now, I mean, I think the risk of an error is very high. You can't have 3% inflation. It's been in place for a while, and there's no sign that it's really coming down at this point. In fact, all the impulse in the economy, from the tariffs to the expansionary fiscal policies, suggest higher demand, and that's inflationary. So I think they're taking a very serious risk. I know they're concerned about slowing the economy. That's why they're talking about lowering these rates and focusing on unemployment. But their mandate is for price stability as well. And if you trade that away, if you let this get out of hand again, the kind of increase that would be necessary would put more downward pressure on long-run employment, which I think would cost them even more credibility loss than they would do by holding firm at least through September. But I'm very confident they're going to ease in September, and we'll just have to see how it follows from there.
Well, it's wonderful to get some time with you after such a consequential jobs report this morning. That is Thomas Hoenig. He is former Kansas City Fed president.
Yeah, and we should point out, Katie, too, I mean, before that Fed meeting on 16th and 17th, we're going to get another retail sales report, PPI and CPI data, as well as an update on consumer sentiment. And then, of course, about a week after that meeting, we get the next PCE report. So the Fed's got a lot of data coming down the pike that they've got to actually take a look at here. We're going to talk a little bit more about that and, more importantly, how the market may react to all this when we come back after the break. Stick with us. This is Bloomberg. Bond yields down, the direction of stocks right now mixed, and a lot of questions going forward about how you position your portfolio given the economic and Fed backdrop. Callie Cox joins us right now, Chief Market Strategist over at Ritholtz Wealth Management. And Callie, you saw the numbers and you know the expectations for the Fed meeting here. How do you position?
Well, I think it's pretty obvious now that a rate cut is coming. The Fed has the wiggle room to do it. I'm thinking a lot about protection and quality in our portfolios. How do you brace yourself against more economic weakness now that the job market seems to be at this pivotal point?
Well, that's the thing, Callie. I do wonder if you include cash in that, because I'm taking a look at money market funds. If you round up, $7.3 trillion sitting in cash right now, but rates are coming down. Do we finally start to see that line move in the other direction, down?
Yeah, well, with cash, you have to balance what you're getting in the interest rate and how much it's going to protect you, what you need for those short-term expenses. The tricky part about cash is that as the Fed funds rate comes down, you're going to see those money market yields come down as well. Cash management is one of those aspects of your portfolio that you really need to nail at the moment. And I think for here, it's important to double check with yourself what your near-term spending needs are and how much you should hold in cash so that you can sleep at night.
And I should just point out that $7 trillion, they've got, a few $1,000s of my money in that cash as well. But Callie, I am curious, in all seriousness, I mean, if we do end up in a rate cutting cycle, not just a one-off in September, that this is the start of a move lower in rates, is there any way to interpret that could actually be good for stocks, particularly some of those higher valuation tech stocks?
Sometimes it is. I think this time is a little bit different, and I know that's a dangerous phrase to say, but right now the Fed is caught between the tension of both sides of its mandate. I know your prior guest was talking about the chance of long-term yields rising if the Fed leans too much into rate cuts. That's a worry of mine too. And I think it's a point that the Fed has to navigate very, very carefully, because if they do lean too much on the job side of the mandate, then we could see those long-term yields tick a little bit higher, and that could elicit a response in the market that maybe pushes us closer and closer to that stagflation reality where nothing works. Growth is slowing and, bonds don't look attractive in a high inflation environment.
So a bright future there that you laid out. Callie, I do want to get your thoughts on the small caps here. They are the outperformer on the day. It seems like a pretty direct relationship between yields going down, small caps going up. Does that hold once we actually get these rate cuts?
Yeah, and I want to be clear, too. I don't think this doomer stagflation is in front of us. I think inflation is probably less of a concern if the job market's weakening, because you need wages to fuel an inflation crisis. But where small caps come in is that, small caps benefit from lower rates. They're more debt dependent. Markets see right through that. And I think this is the rate cut trade in motion right now. I'm not sure how long it lasts, especially as the job market continues to weaken, because what small caps need are really that high growth, low rate environment. And the growth side of the equation is something we're not getting right now.
Absolutely. Callie, great to get some time with you. Have a great weekend when you get there. That is Callie Cox. She is Chief Market Strategist over at Ritholtz Wealth Management. And the small cap trade, Romaine, it just, there's a lot of hopium there.
There is a lot of hopium. I mean, how many times have we seen the resurgence in small caps this year? Maybe this sticks.
Maybe this time is different. We'll just have to see. Now, coming up next, the CEO of DocuSign joins us hot off the company's earnings beat. We'll get the download on why the company just boosted its full-year billings forecast and any warning signs that he's seeing. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. That beautiful backdrop. Have you seen the new JP Morgan Tower there?
I've heard about it. Haven't seen it in person yet, but I hope to.
Okay, we just saw it there on the screen. I'm Romaine Bostick.
And I'm Katie Greithaupt. I hope to go outside one day, but I'm glued to these markets right now.
Out there.
We have about 30 minutes until the close. Volume higher, as you might expect, even though it's a Friday afternoon.
Yeah.
A consequential jobs report.
Consequential. I know we're supposed to talk about the jobs report and set up our next guest on AI. I just want to talk about that JP Morgan building for a second.
Because
I actually had a chance to go over there last night.
Did you?
Yeah.
Okay,
and
flex.
Saw it. Yeah, it was a flex. Got to see the inside of it. But then I was in another building over the new One Vanderbilt. The One Vanderbilt, and I got this, and you had the skyline view of it, and it is impressive. I didn't realize just how dramatic of a statement it was going to be. I mean, the New York skyline is just so iconic, you know.
And you could
Empire
probably see
State
New
Building,
Jersey from
Chrysler
there.
Building. Well, I was facing the other way, so I saw Brooklyn or Queens or whatever that is.
All
over
right,
there.
well,
but you know, I'm sure Jersey's beautiful too.
Yeah, it is.
Do they have
beautiful.
a skyline over there?
They
have the Palisades.
They have the New York skyline that you can see if you're standing on the shores of the Hudson River in New Jersey.
Yeah, that's what Jerseyites always say, right?
Yeah.
Is that the best thing about living in New Jersey is that you have the great thing, except you're in New Jersey.
There's so many great things about living in New Jersey. It's hard to pick just one. I will say, though, when it comes to the market that we're living in right now, just to bring us back
to the
a little
markets.
bit, it's interesting to think about the trajectory of markets over the course of this day, because you got the numbers coming out at 8:30 in the morning. It looked like it was going to be a bad news is good news sort of scenario.
Yeah,
not to
future
rely.
spiked.
Yeah, exactly. Not to rely too heavily on cliches, but that seemed to be the trade. That momentum lost. A different story for the bond markets, though. You saw that bid come into the bond market, and it's really held that throughout the trading day.
Yeah, and just to kind of put a point on that, I mean, it has to be open higher, up 0.4%. It then dropped about 1%. It's now kind of paired some of those losses. The bond moves was a straight shot down on the yield side. I mean, we knew that was going to come here. And I guess the question is right now is like if the Fed does come in September 17th, gives us the 25 basis point, the quarter point cut. The question is, what does Jay Powell articulate about what they do at that October meeting, that December meeting? Because if you look at the Bloomberg, you type in the word function, you now have traders actually pricing in as many as 3 cuts by the end of this year, something they hadn't really priced in months. I mean, I know at the start of the year, that's what they were pricing in, but that was kind of off the table for a long time.
Yeah, absolutely. That was the trade, right? Not just to solidify the bets on September, but look to October, look, of course, to December as well. I will say it does seem like a cleaner trade when it comes to the bond market. How exactly to express that? You think about the reasons why the Fed is cutting, and you could get a little bit concerned if you're thinking just about equities.
Absolutely. And I do want, and just on the equities point as you count down to the close, it's kind of interesting to see some of the rate-sensitive stocks. I mean, we talked about the Russell 2000. Bank stocks actually lower across the board, but home builders actually doing well, maybe on the prospect that mortgage rates might come down. So anyone out there, if you know anyone who's looking for a home, maybe now's your time to buy, and you can thank Jay Powell. All right, we're going to check in on some of the other big movers today, including a big move higher on Broadcom and a big move lower on Kenvue. And we are going to talk about DocuSign as well after a big earnings beat. Stick with us. This is The Close on Bloomberg.
Shares of DocuSign jumping after earnings beat. The company boosting its full-year billings forecast in what it called one of its highest growth and profitability quarters in recent years, citing AI innovation as a leading catalyst. Joining us live, I'm pleased to say we have DocuSign CEO Allan Thygesen. And Allan, just to get specific here, so billings $3.33 billion to $3.36 billion. The previous range was $3.29 billion to $3.34 billion. So quite a boost there. Talk us through where exactly that growth is coming from. What gave you the confidence to boost the range there?
Yeah, we're really seeing strength across the board. Our core sign business, everyone's familiar, is doing well. But I think the real growth driver for the company is our new AI-enabled intelligent agreement management suite. It's seeing excellent results. We've been out for a little over a year with it, had some early success with smaller companies, and now we're starting to see enterprises pick it up as well. So very promising, and you can get benefits from it right away. So I think that's, there's a lot of hype about AI, but I think DocuSign is able to deliver results very, very quickly to companies that are looking to learn more about their agreements and generate more value from them.
So the Intelligence Agreement Management product, IAM, are there any particular industries that are embracing that tool? You mentioned that you're seeing some uptick among those smaller companies, but can you isolate that to a particular sector that seems to be quite jazzed?
No, to be honest with you, we have a very broad portfolio of customers. So everybody from the finance industries to manufacturing industries to tech to business services, governments. We deploy to companies of all sizes and in all industries.
There was also some discussion, both in the statement as well as on the conference call, about the relationship, the partnership with the federal government, particularly with the General Services Administration. How much of a factor is that going forward on your business? Is it accretive?
Yes, we expect that it will be. We have a decent federal business today. We're present in all 15 cabinet level agencies, but it's not been a big part of our business. And we think there's big opportunity, and I think the GSA agrees, and so we struck this agreement to make it easier for all government agencies to buy DocuSign and help automate their agreement processes and generate more insight. And I'm very optimistic. I'm actually heading to DC next week to have discussions with a number of agencies. I
am curious about how your business is affected by macro conditions. And I want to start first with interest rates. I mean, obviously, for a lot of consumers, I mean, some of our first experience with DocuSign comes when you buy or refinance a house here. And we know the housing market, mortgage market at least, has been somewhat stagnant. If rates do start coming down and you do start to see more activity in the mortgage and refi market, how much have you already factored that in, I should say, to your outlook? And if not, when do you think you'll have enough clarity to do so?
Yeah. You're right that a lot of our early growth was powered by financial services more broadly, not just mortgages, but bank account and credit card openings, those kinds of things, wealth management. But now it's really very diversified across industries. So we're not as, should we say, interest rate sensitive as we might have been, let's say, 5 or 10 years ago. That said, I think if interest rates come down and should we say, loan activity or account opening activity picks up, that'll benefit us. We did not put any of that in our forecast. We'll have to see what the Fed does and how that rolls out in the economy and how meaningful it is. Generally, we're just very, very diversified, and so anything that affects one sector of the economy, there's often counterbalancing effects elsewhere, and so it doesn't show up as pronounced for us as maybe for other companies.
So you didn't put that into the forecast. And with that in mind, I do want to talk a little bit more about the outlook, because I'm reading the reaction from our analysts over at Bloomberg Intelligence, and they write that actually the billings outlook for 5% in the third quarter seems conservative, especially given that you surpassed your second quarter billings target by about 400 basis points. So could we actually see you raise that outlook? Do you agree that 5% maybe you were being a little conservative there?
Part of what's in that forecast is that we had an extra normal amount of early billings. These are customers who enter into contracts before they have to. And we expect that to reverse itself in Q3. And so that's about 3 percentage points excess in Q2 that probably will come against us in Q3. And then the whole thing looks a little bit smoother. So no, I mean, we guide to what we see, and we think the underlying trends for DocuSign are very positive. Our billings growth is up year over year, and we're very pleased with the underlying trends in the business.
Well, let's talk about the existential question that is hanging over every industry. That, of course, is AI. You mentioned that you see it as an opportunity, Allan, but a skeptic could say that they could see your industry being pretty disrupted by AI, and I wonder how you future-proof against that.
Yeah, no, we do feel AI is an enormous tailwind for DocuSign. So, look, it's true that for anyone who works with agreements, AI enables whole new levels of insight. You know, agreements that were essentially dumb, flat files previously, now you can extract information from them. And that's, of course, very ubiquitous, and you can do that with consumer LLMs. But I think what's unique about DocuSign's position is we have a deep, deep understanding of agreements and can answer much more precise questions, the kinds of questions that companies want to know about their agreements. We're involved in every step of the workflow. So we know, for example, what the drafts look like, what was negotiated, who the parties are, and so on. And so all of that feeds into being able to deliver value from agreements, both from making it more efficient to enter into them and extracting more value out of them. We are seeing clients of all sizes and all industries take to these new AI-enabled tools, and I think it's going to be a major growth driver for us going forward.
All right, Allan, we'll hope to talk to you in the future here about that progress. That's the CEO of DocuSign there, Allan Thygesen, here on a day. The shares now headed for a fourth straight week of gains here. One of the best performers, at least in the mid and large cap space. Let's turn now to one of the worst performers out there, Kenvue. It's our stock of the hour. The shares having their worst day on record. This after a report from the Wall Street Journal that the Health and Human Services Secretary, RFK Jr., is likely to link the company's Tylenol painkiller with autism. Let's bring in Bloomberg reporter Jessica Nix to find out a little bit more about this. Acetaminophen, the main ingredient in there. Some questions about whether there's a link to autism. Has this been something we've known about?
No, actually, there was one study in 2024 that found among Swedish siblings, there are about 2.5 million that they studied. There was no link between autism and the Tylenol that a pregnant mother would take. Of course, this is also coming as Kennedy has said before that there is possibly a link between vaccines and autism, and that's something that he wants to study. So this idea that acetaminophen is now being tied into it does seem new. Yesterday, he was on the Hill taking a lot of questions and a lot of heat about his views on vaccines as well.
And he didn't answer those questions very well, at least in terms of actually providing some data as to what is backing up those beliefs. Is there data on this at all that we know about or that has been reported on?
Not really. There hasn't been data that has shown this link in the past. And in fact, doctors actually tell pregnant mothers to take Tylenol instead of Advil or ibuprofen because there is a link between ibuprofen and potential birth defects or complications with birth.
Well, for its part, the HHS said in a statement that until we release the final report, any claims about its contents are nothing more than speculation. We're expecting that report in the next month, correct?
Yes, sometime in the next month. This would be the second Make America Healthy Again, or MAHA, report to come out. The last one we had was in May.
All right, Jessica, really appreciate your reporting on this story. That is Bloomberg's Jessica Nix. You take a look at the reaction in Kenvue shares, even though as the HHS dismissed this as speculation, Kenvue shares down about 10%, on track for the worst one-day drop on record.
Yeah, and this raises a lot of questions just about kind of policy risk and the idea of whether the policies are actually backed up by data or science. The idea that you have effectively the government basically saying, this is what we think is happening, and if you're on the wrong side of that, you get a day like today. So Kenvue down 10%.
Yeah, and of course, we will get that report in the next month, but clearly investors choosing to sell now. Now, coming up, we'll take you to the closing bell with Ann Berry. She is founder and general partner at Threadneedle Ventures. That conversation up next. This is The Close on Bloomberg.
The closing bells here on this Friday, just about 10 minutes away. A mixed week and certainly, Katie Greifeld, a mixed day for stocks.
Yeah, really interesting trade today. Of course, we got that labor market data at 8:30 this morning. It was ugly, and you can see that the S&P 500 on track to finish down about 0.4%. Big tech, interestingly enough, slightly unchanged on the NASDAQ 100, even though you do have the likes of NVIDIA lower. The small caps are your outperformer today. The small guys are the biggest winners. The Russell 2000 up about 0.4%, probably because of what's going on in the bond market. Yields sharply lower. The 2-year Treasury down about 7 basis points.
Yeah, and it's kind of interesting, too. We talk about sort of that rotation with regards to small caps, values, cyclical stocks relative to vis-a-vis the large cap stocks here. That's been the tug of war now for quite some time. In fact, on this day, half the stocks in the S&P higher, half are lower. And for the week, a similar story playing out as well. So where do you go next? Ann Berry is the founder and general partner over at Threadneedle Ventures. She joins us right now to help count us down to the close. And I do want to start there, Ann, with this idea of valuation. We were all kind of wringing our hands over this for the last couple of weeks. Coming out of the earnings season, we've seen the earnings, particularly out of some of the big tech companies, particularly out of the big AI players. At least for right now, we know that's intact. When you look at the valuations, though, and maybe the potential returns or lack thereof, do you still find that trade attractive?
I think what we're seeing now, Romain, is a little bit more discernment around which tech stocks perhaps have got some more upside. And I'll give you an example. I think, I've been in talks with Katie before about Palantir and how that valuation has reached levels that have become very difficult to justify. I think there are some other spots now in tech that I call sort of the grandfathers or the elder statesmen in software, which to me are beginning to look fairly reasonably priced. And one example of that, Salesforce. And I think, Romain, that's an example of a business that's been leaning into AI, has been spending on product, has been using it internally. It's been reducing its own workforce size, using its agent force technology. But its top line's not growing fast enough for the market that's gotten used to a narrative of sort of turbocharged growth whenever the words AI are uttered. And so I think Salesforce is an example of a software stock that's been overly punished for actually giving credible and reasonable projections of growth, which is, a little bit under 10%, but is actually more reasonable when you look at the maturity of the businesses they serve, the level of subscription rates and lack of attrition they've got, the stickiness they've got with their clients, and their free cash flow generation. So I think looking at cash now instead of just turbocharged growth is quite an important way to try and find value in this market.
I'm curious, though, on that Salesforce, too, because this has been one of the surprising laggards of this year. Yeah. It last hit a record high late last year, down like 25% or more so far year to date. For a company that at least has proven itself over the years, what do you think's holding it back? Is it the idea that the AI strategy hasn't been articulated, or people just don't buy in to what has actually, I guess, been sold to them with regards to the pitch coming from the CEO?
I think actually articulated pretty well. I think Mark Benioff actually articulated what Agent Force is and its potential pretty well, number one. I think people do buy what he's selling. I think they are saying what you're articulating in terms of the growth rate of 8.5%, 9% is right. But I think what the market is saying to him is it's just not good enough. Right? When we think about the glamorous stories coming out of places like Ritholtz, which is a private company that's going after the workday. If you look at companies like Midjourney, private company, aggressively moving into the territory of someone like Adobe, I think what we're seeing is the narrative around these private companies in AI growing very quickly, unbelievable trajectories. And then you look at the public companies that they're basically going after in terms of market share. I think the market's just saying, look, we can't size the risk of displacement, and it could be really material. I happen to think it's going to take a little bit longer for the Salesforces of the world. Adobe, on the other hand, I think deserves where it's been trading down to. But I think that's what it is, Romain. I think it's trying to square where is actually the right steady state level for some of these older software businesses.
And Ann, I want to get your thoughts on one of the other big corporate stories of the day, of the week, probably of the year, and that is Tesla proposing a compensation package for Elon Musk that could be worth around $1 trillion if he does hit some of those metrics. Romain made the good point that this will probably be the subject of a lot of case studies on corporate governance, but I'm curious how you're approaching it as someone in this market.
Yes, I think the following. If I were a Tesla shareholder looking at this, my reaction is, look, if he gets the business to an enterprise value of $8.5 trillion, Katie, which is what he needs to sort of be hitting in terms of value creation to realize that $1 trillion of compensation value, and really what he wants, which is sort of control an equity stake that is large enough that he controls the business, something that a lot of his peers in tech do as founder CEOs, and he doesn't right now. I think a lot of shareholders will say, fine, but here's what I worry about. Look at how it got to this point. Right. It took Elon Musk getting so diversified in terms of how he spends his time that the board has now had to go to astronomical lengths, setting unbelievable eye-popping precedents on his comp package to get him to come in and focus. So here's the question I have around this. If I'm Alex Karp at Palantir, if I'm Jensen Huang at NVIDIA, if I'm Mark Zuckerberg at Meta, founder CEOs, iconic, focused for the most part. What if they start going off now and start getting involved in other businesses, getting some side hustles, getting political? Are the boards now going to turn around and say, look what Tesla had to do with Elon, this is what we need to do for these guys? That's the precedent I'm focused on.
Yeah, it's really interesting, and I'm glad you brought up Mark Zuckerberg because my mind kind of goes there. I mean, that's a founder turned CEO, still the CEO. I know that Elon Musk, not necessarily the founder of Tesla, but Mark Zuckerberg has fantastic control over Meta at this point. You think about all the different paths that company has gone down at the behest of Mark Zuckerberg.
That's exactly right. And even if it's not one individual, there are other businesses where the founders collectively still control the business, like CoreWeave being an example. Collectively, they have voting control. I think it's Airbnb that for the longest time, the founders collectively had voting control. And so Mark Zuckerberg, like Elon Musk, you've got one person who really does represent the vision, the execution. Investors have stood behind Mark Zuckerberg and said it's okay that you've got complete governance control because you're sufficiently important. Again, that's the precedent that says if you're a founder, become CEO, the public shareholders, will take your cash, but there's a price for having me stick around and there's a price for having me focus. And again, just what Elon's been able to achieve in negotiating this package, it still needs to be voted on early November, is unprecedented in terms of what it says about one person's power. And the other thing I would just say, Katie, the kinds of companies we're talking about, Tesla, Meta, NVIDIA, look at the proportion of the overall US equity market they represent. So this isn't just a concentration of voting power that's relevant to one company. It's relevant to control over a massive chunk of US equity market valuation.
Yeah, it's going to be interesting to see how this fight plays out. Remember, right now, still a proposal, still proxy. The shareholders have to vote. But of course, we've seen how these shareholder votes at Tesla have gone in the past. And have a wonderful weekend. Ann Berry, founder and general partner at Threadneedle Ventures. We should point out Tesla up 4% on the day, about 5% on the week, at its highest level since February.
Yeah, absolutely. You think about, again, the Elon Musk premium. You can see it alive and well in shares today.
Meanwhile, Salesforce shares higher on the day, but lower on the week. In fact, that stock has not been above its 200-day moving average since March.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld, taking you through to that closing bell with a global simulcast. It started. There's Carol Master. There's Tim Stenovic in the radio booth. Welcome to our audiences across all of our Bloomberg platforms as we close out this Friday with a lot of big questions here about the direction of the market, the direction of the economy, and the direction of interest rates.
So well said. Tim and I were just saying, it's not a quiet Friday. It just feels like a lot of things are coming from the White House right now. Lots of questions. We know the president is expected to speak maybe in a few minutes from now. In the meantime, I feel like the equity trade says it all. Some enthusiasm maybe initially over expectations of rate cuts, but now it's also maybe the realization that the economy is slowing down in the U.S., and that's not necessarily a good thing. Yeah, we just spoke to Louis Navalier over at Navalier & Associates, who, when we asked him, is the Fed too late? He said, yeah, the Fed should have cut back in June. You know, he's citing the labor deterioration that we've seen in the labor market here in the U.S.
Yeah, and you can see all these questions coming through in the stock market, but a conversation we were having about when it comes to the bond market, the trade looks much cleaner, at least on this one day. Yields shot lower after we got those numbers at 8:30, and they've pretty much stayed there.
And it's going to be kind of interesting these next couple of weeks because, I mean, earnings season is largely over. We do get Oracle and Adobe next week. That could have some impact on the market. The Fed in a quiet period as we wait for that September 16th, 17th meeting. But we get a lot of economic data in between that. A retail sales report, CPI, PPI next week, and consumer sentiment numbers at the end of the week.
Listen, we're counting down to the Federal Reserve's next decision, and all of those data points, we know that Romaine will be important.
We should point out the S&P here on the day did actually open higher. The idea here that with a weak job market, the Fed would cut rates and a drop in rates would underpin valuations here. But that enthusiasm faded. The S&P was down almost 1% on the day, pairing some of those losses, and looks like it's going to close down now by about 20 points or 0.3%. The Dow Jones Industrial Average, a favorite of Katie Greifeld's, lower by more than 200 points or 0.5%. The NASDAQ Composite, we're just going to call it unchanged. It is a red arrow, but basically unchanged on the day. The NASDAQ 100 actually squeaking into the green, up 19 points or about 0.1%. And we've been talking about it all day, Carol and Tim. The outperformance that we saw today in the mid caps and the small cap Russell 2000, both of those indices up about 0.5% on the day.
All right, interesting to see that divergence in terms of performance. performance. I'm going to go back to the big caps, if I may, the S&P 500. And folks, not quite an even split. 273 names, Katie, to the upside here in the S&P 500, 230 losing ground.
Well, it's a really interesting mix if you take a look at the sector breakdown as well. You take a look at the circle, there's a lot of red, but the green, real estate, is your biggest gainer on the day. That sector up about 1%. That has to do, of course, with what we're seeing in the bond market. Rates are coming down. That is good, theoretically, for real estate. Communication services and materials also joining in on the party. But then you take a look at the downside. Energy, your biggest loser today, then financials and industrials also having a pretty sour end to this week.
All right, let me get to some of the individual gainers. And Tesla, we saw this definitely some outperformance here, up 5% at its highs today, closing with a gain of 3.6%. Tesla proposing a new compensation agreement for its CEO, Elon Musk, potentially worth around $1 trillion. There's a lot of caveats around it, I would say, but it is a massive package with that president in corporate America. Tesla seeking assurances that Elon Musk would wind down his political work. So we also heard from a Tesla board member, at least
Wind
CNBC.
down his political work.
Well, you know what that
means. I think the Trump administration's already done that. But it raises a big question, Carol Massar. In all seriousness, we talk about $1 trillion pay package that a lot of people, I think, Katie, you pointed out at the start of our show, to get all those incentives, it would actually have to take the market cap of this company to what, around $8 trillion. It's at $1 trillion now. I would also like to point out it was at $1.5 trillion at the start of the year. So I'm a little curious as to what they're actually paying for here.
It's a great question. It's a question I posed actually to our Ed Ludlow, who reminded us about NVIDIA just a short time ago and the small market cap it had and how it has certainly blossomed. So I don't know. I guess time will tell. So, yeah.
NVIDIA makes basically the only chip out there to power the AI revolution.
Just a graphics chip processor, and the market cap wasn't as large. I'm just saying.
Okay, that's a false equivalency, but go ahead.
Okay. I'm just going to ignore you. You must have missed me. All right, let's go to Zoomies. Zoomies, ticker is ZUMZ. Stock up about 15% in today's session.
What is this? I always hear this stock. What is this?
$357 million market cap. It is a small market cap. This is something that's probably in your wardrobe. There's sneakers, there's skateboards, there's a lot of things. Snowboards as well. Anyway, it reported better than expected second quarter sales, issued third quarter sales guidance that also topped estimates. And moving along, chips, definitely some outperformance among the semi area today. Broadcom, number one gainer in both the S&P 500, NASDAQ 100, gain of 9.5%, up more than 16% intraday here. Wow. We know the company reported its latest results, but it really has to do with that FT report initially, and then Bloomberg following up that the chip maker is said to be helping OpenAI design and produce an AI accelerator. For 2026.
Can I just say a few weeks ago on this program, I got a lot to say today, Carol. A couple weeks on the program, Jake Goldberg over at Seaport was talking about this idea of the chip space, all the focus on NVIDIA, and he was the one who flagged to me. He's like, look, take a look at Broadcom. It's outperformed NVIDIA this year. It's up 44%. NVIDIA's up like 25%. And he was really bullish on this idea that Broadcom really has an ability to make its mark in the AI space, and that investors hadn't really appreciated that. And I think based on what we learned yesterday, maybe he was right.
I have something to say, actually. I have also heard calls that Broadcom should be part of the Magnificent Seven. I'm going to say it here. Call it the Great Eight. We could come up with a new name because Broadcom really has proved its worth this year.
All right, we'll see if the Great Eight sticks. If it does, thanks, Katie Greifeld, for that one.
I stole it from someone.
Romaine, I know you're just... We were gone yesterday up at the Power Players Summit, so it sounds like you're making up for lost time with no simulcast.
We've been chatting up.
We actually did the simulcast. We just did it with.
Oh, you did?
Yeah.
Okay. It was just the two of you. The two of you talking to each other.
Pretty much.
Okay.
We got to keep our radio listeners.
Well, I want to keep things moving and talk a little bit about NVIDIA. On the Broadcom news, Broadcom's gains were NVIDIA's losses today, down 2.7%. Shares actually fell as much as 4.4%, falling at one point by the most since April. Once again, NVIDIA down by 2.7% today. And then a late mover, Kenvue, down 9.4% today. It's the former consumer healthcare division of Johnson & Johnson, down as much as 16.5% earlier this afternoon. Shares fell after the Journal reported that HHS Secretary Robert F. Kennedy Jr. is likely to link the company's Tylenol to autism. The federal government is expected to release its finding on autism this month. The HHS, though, came out with a statement after this Journal report came out and said any claims about the report's contents are speculation until it is released. We should note that Kenvue said, quote, nothing is more important than the health and safety of people who use its products, and it believes there's no causal link between acetaminophen use during pregnancy and autism. And finally, Lululemon shares down 18.6% today. This was the worst performer on a percentage basis in the S&P 500.
Right.
The company slashing its outlook due to weakening demand. The Trump administration's tougher trade policies as well. At least 7 analysts downgraded the company's stock.
Yeah,
today.
I was really shocked. I mean, we were on, well, that's right, you guys weren't here yesterday, but we were covering that in the after hours yesterday. And the idea, remember, this was like the untouchable stock. It seemed like it didn't matter the economic conditions, it didn't matter anything. They always seemed to grow sales, grow profitability. And this is like the third straight quarter where they've really surprised to the downside.
Do you think tariffs are really to blame here, or is this the fact that consumers have a lot more options here?
Yeah, no, I don't think that.
A lot more options,
yeah.
And maybe they're not as interested in what Lululemon is offering right now.
Yeah, and we had an analyst on yesterday who kind of made that point, the idea that there's really just been some internal mistakes they've made with regards to marketing, with regards to pricing. But, you know, they're trying to course correct that, and we'll see. We'll see what happens. I do want to turn real quickly to yields, guys, because that, of course, was a big part of the story. Your 2-year yield, a massive drop on the day, and more importantly, a massive drop on the week. I just want to point, this is the 4th straight week we've seen the 2-year yield decline. So at least in the open market, in the secondary market, you have traders really betting on the idea that there is going to be a slide in rates pretty soon. But at the Fed, we'll start this rate cutting cycle. You also saw the 30-year dip on the day and on the week. It's the most meaningful decline that we've seen on a weekly basis in quite some time, down 16 basis points. Remember, we started the week, everybody was fretting about 5% yields on the 30-year. That's now down back below 4.8%.
Yeah, pretty significant change in the narrative. All right, here's something kind of interesting that caught our attention from the Wall Street Journal. It has to do with a UFC cage match coming to the South Lawn of the White House.
The White House?
A little bit later this year, or next year, I think it actually is.
Wait, so Trump's going to fight in the cage?
No, it's not going to be.
No, mixed martial arts throwdown to be watched by thousands of spectators. There's lasers, there's fireworks to light up the sky. The UFC's octagon cage will be flanked by the White House and the Washington Monument. This is from the Wall Street Journal. I'm reading it right there.
Yeah.
As combatants punch, kick, and grapple each other.
Oh, yeah.
Many more
exactly
people could watch on jumbo
House.
Screens set up on the Ellipse, a park south of the White House or other areas
this
nearby.
is very violent.
I will tell you, I'm going to tell you guys something.
All right.
Not a big UFC fan.
No, you aren't.
I am not.
A big UFC fan.
Well,
I think full disclosure, I don't understand.
What if they were on bikes? Would you like it more?
That's control room's laughing about that, Katie.
It was a funny joke.
Yeah. U.S. Open happening right now. Djokovic and Alcaraz playing as we speak.
Is there grappling in that?
There's not, no. And the president reportedly will be going to the final on Sunday in Flushing.
Oh, yeah. Well, I'll be there, too. I'll say hi to him.
You guys.
Yeah. Big tennis fan. You don't know that. Not so much MMA. I'm like you. I mean, I don't like to see people get punched in the head. I don't know. I mean, teach his own.
All right, to each his own.
There you go.
And that, we're going to have a
grappling
wrap
event. I mean, I could see that on the subway.
Are you done?
That's true.
Done? All right, that's a wrap. Across platform, radio, TV, YouTube, Bloomberg Originals. We call it.
Is Carol's mic on?
I just couldn't get a word in edgewise. What could I tell you? Hey, guys, have a good and safe weekend. Enjoy the Open and other stuff. And we will see you again, same time, same place on Monday.
Our coverage continues here on Bloomberg Television. Actually, a lot of news here on this Friday afternoon that we have to get to, from Wall Street to Washington. And of course, particularly when it comes to the big bets right now and what the Fed may do next on the heels of that surprisingly bad U.S. jobs report. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostick, and we say this a lot on The Close. Well, it could have been worse. Stocks did close in the red on the day, but quite frankly, it really wasn't that bad. The S&P 500 pulling back about 0.3%. It did open higher on the day, dropped about 0.9% at one point before paring some of those losses. You also saw a lot of activity in the small cap space, something Katie was talking about, particularly when it comes to a lot of those rate-sensitive sectors. Take a look at the home builders, the S&P 1500 home building index, 2% higher on the day as a group. That is a record high. Meanwhile, bank stocks have been under pressure, and we will continue to keep an eye on yields, which drifted lower on the day and on the week, Katie.
So we'll keep an eye on yields, but let's talk about some of the individual movers that made some headlines today. I started with an up arrow story. It's going to get worse from there, but Broadcom higher by 9.4% on this Friday. We know that they reported earnings yesterday. That's not necessarily what you're seeing in the stock today. We had reports that they're working with OpenAI on a new AI chip that certainly put some enthusiasm into into shares of Broadcom. Lululemon reporting yesterday, wipeout, and you can see that in the shares down almost 19%. And then I wanted to end with Kenvue. We were talking about this, of course, that Robert F. Kennedy Jr. is set to link it to autism in an upcoming report. Shares down more than 9%.
Yeah, and that board not only does it really sort of encapsulate what happened today, but really what encapsulated all week long. And that brings us to our top story and where the market is really going to focus their decision, a big decision for the Fed in a week and a half. This after a downside surprise today in U.S. labor market data. 22,000 jobs created in August, barely a third of consensus estimates. And the downward revisions announced 30 days ago for May and June, remember that? Those are the revisions that showed the U.S. added just 14,000 jobs, or 130,000 fewer than first reported. The revisions, those are the ones that cost the BLS commissioner her job. Those numbers, they were revised even lower today. BLS now saying in June the economy lost 13,000 jobs. This is a job market at a standstill. That is now unambiguous. The question is, what does that mean for Fed rate cuts, particularly given the persistent inflation that, well, would potentially argue for rate hikes? The market reaction today was swift, though it was orderly. Equities fell, bond yields plunged, and the safe haven of gold notching a third straight week of gains, touching $3,600 an ounce intraday for the first time in 105 years of record keeping. Joining us now to talk about where we might go next is NatWest Markets Michelle Girard. She runs the commercial and institutional operations that supports the bank's business customers. And Michelle, this was a surprise for most of us. We knew there were cracks in the labor market, but I am curious if this sort of big drop that we saw last month is maybe a harbinger of what we should expect in the months ahead, or maybe potentially a one-off.
Well, I think even smoothing through what happened last month, what's probably most clear is when you look at the trends, particularly, let's say you look at what's happened since April when the tariff increases were announced versus before that. Since April, we've seen job payroll growth, excluding government, in the private sector, of less than 40,000 a month, compared with gains of over 100,000 a month over the prior 4 months or the first 4 months of the year. So you've really seen, as you said, the hiring situation sort of come to a bit of a standstill here. And I think it's reflective of the uncertainty that companies feel about policies. So again, looking through sort of the ups and downs and revisions, the trends, I think, reinforce the idea that the Fed themselves have now acknowledged, which is that the labor market has softened to a point that has left the door open for consideration of rate cuts.
I mean, when we talk about capital markets, particularly equity markets, of course, there's sort of this potential that bad news could be good. And we saw stocks actually rally when that report first came out, at least futures. The idea that lower interest rates, assuming that we are in a sustained rate cutting cycle, of course, that would actually help to justify current valuations and maybe even prop up future valuations. Is that a rational way to look at this, at least for equities?
Well, it's interesting because, as you said, initially the market opened higher, seemingly that the bad news would be good news because of rate cuts. I think you have a couple of things going on here, though. There is some mixed messages about the U.S. economy. Clearly, as we've talked about, the employment situation has cooled, and the labor market is probably one of the most worrisome parts of the U.S. economy right now. But as we all kind of have been noting, you are seeing consumers continuing to spend. Even within the employment data, you saw strength in areas like retail employment, leisure and hospitality. These are, typically cyclical sectors that would be reflecting economic weakness in core parts of the economy. They're showing relative resilience. You look at the earnings results, you look at profits, you look at productivity. There are good things happening with respect to the economy. And so in that sense, I think you're seeing some, the equity market is taking some solace in the fact that the fundamentals potentially for future employment being better, good profits by companies are actually still in place.
Michelle, I want to bring this conversation more directly into the bond market because I've been making the case over the past hour or so that it seems like a cleaner trade when it comes to the rates market. You just see two-year yields dropping here. And I wonder if I'm oversimplifying things, whether there are certain nuances that should apply here.
No, I think you're right. I think what you saw today was the market reacting with the employment situation now known. I think that was the one factor that people felt might keep the Fed from cutting rates in September. If you had an unexpectedly strong result or some revisions that reversed what we saw last month, maybe there would be more debate or pushback against a rate cut in September. Clearly, that didn't happen. And so the door was seen as now left wide open. The market fully priced in not just a cut in September, but began to price in 2 additional rate cuts. So, we had been looking for a cut in September, maybe December. Now, even the possibility you'll see rate cuts at each of the 3 meetings remaining over this year was priced in. And so that was a pretty clear move in the markets, again, reacting to the employment situation now being known and out of the way.
And we don't have much time left, but I do want to talk quickly about the long end. The 1-year chart of the 10-year Treasury yield is one of my favorite out there because you saw that jumbo rate cut in September, and then you saw this amazing climb when it comes to 10-year Treasury yields. Is there a risk that we could see a repeat?
Well, you do certainly see the curve steepening. That is, long-term rates are not falling as quickly as short-term rates. Part of that is the concern around fiscal policy. I think there's concern, right or wrong, that if the tariff increases are not proven to be legal, that will undermine, revenues coming in, put more pressure on the fiscal deficit. Concerns that maybe rate cuts could lead to higher future inflation. So you are seeing that the declines in yields at the long end of the market, where other factors are other than just the policy rate, have more of an influence. You're not seeing as much of a decline, and the yield curve is steepening as a result of the backdrop.
All right, Michelle, have a great weekend when you get there. That is
Thank you.
Michelle Girard. She is head of U.S. at NatWest Markets. Now, coming up, we'll take an even closer look at the workforce with Callie Monahan of Upwork Research Institute up next. This is The Close on Bloomberg. Well, today's payrolls report is validating fears that the U.S. labor market may be on the brink of a downturn. Despite the weak numbers, though, new data from Upwork shows that the freelance economy is still thriving, especially when it comes to AI-augmented roles. Joining us now to discuss is Dr. Callie Monahan. She is managing director at Upwork Research Institute, where she leads research on remote workforce strategies. Great to have you with us. So give us the optimistic take on what we're seeing when it comes to AI and the impact that it's having on the labor market.
Absolutely. I think today what we're seeing, obviously with today's jobs report, is a bit of a softening, right, and contraction that's happening in the full-time labor markets. And in fact, our data shows when we went to the beginning of the year, 55% of company leaders were actually preparing for a low to no growth environment. And during these times, what is most important is being able to create agility. And we know today there's so much pressure to get this AI moment right. And so what we see happening to our platform is both large businesses as well as small and medium-sized businesses are coming to get specialized AI talent. In fact, we saw a 41% surge in AI and machine learning jobs this past month on our platform.
That's really interesting. So talk to us a little bit more. It sounds like you're saying that this cuts across all size tiers, but is it particularly pronounced, for example, when it comes to a small business versus a large business and what exactly they want to see in terms of AI skills?
Right now, the demand is pretty balanced, and the demand shows up in 2 different ways, less so by business size, but more of the type of AI skills that are needed. The number one skills that people are coming to Upwork for, whether a small business or a large business, is machine learning, Python, coding skills, really being able to build and operate AI within a larger system. But the second thing that we see emerging, which I actually think is pretty exciting, is we see fact checking and really keeping humans back in the loop. And so I think a lot of organizations went and installed AI systems, tried to play around with AI content. And what we see actually happening is that humans need to remain in the loop. And we know even the best AI models out there, right, are going to be about correct 90% of the time. And so bringing those humans back in to really evaluate and fact check the output is beginning to grow in great demand on our platform today.
I am, though, curious, Callie, when we talk about this idea of demand for these workers, I mean, we've heard from a lot of these companies that have been doing the hiring about how their own use internally of AI, to a certain degree, will actually reduce the need for some of those workers. And I mean that even within sort of the coding and AI space. So I am curious as to where that balance is, at least as you're seeing it through the sort of the lens of freelance.
Absolutely. So it's funny, there's some other data that came out this week, too, that showed the reasons for layoffs. 0% of the layoffs that occurred in August were attributed to AI or technology. And so I still think that's years down the road. And when we actually fully trust AI agents, and the question is, again, as a business leader, where are you going to trust AI to fully execute? I think in most cases, we're still going to want that human in the loop to make that final judgment and decision maker. And so I think the reality is today, there's a lot of pressure to get the balance sheets right, to maintain costs. And I actually think what's going to be most important today, we're in a low to no growth environment. I think that's pretty clear.
Yeah.
And so the reality is many organizations are trying to continue to find external growth.
Yeah.
What I actually think is needed is internal innovation. How do you source that talent? How do you actually think about building more agility into your talent models? I actually think we're at the structural shift where leaders need to play by a different talent playbook.
Before we go, I do want to get your thoughts, though, also just about, I mean, the whole nature of your platform, and correct me if I'm wrong, it's a lot of creators out there. And when we talk about AI itself, there's been a certain threat or a perception of a threat to that creator economy. The idea that if you can get AI or some type of automated technology to create that stuff, you don't necessarily need the human beings there. Just earlier today, Anthropic had to settle a suit with regards to some content creators, authors who raised copyright claims. How is that being addressed right now on the platform?
Yeah, Romain, it's just an interesting point you raise. We actually see the content creator economy really beginning to grow. 15% of all U.S. jobs posted today on our platform are coming from small to medium-sized businesses that need content creation, website design, social media strategy, that sort of thing. And that is actually the area that I'm most bullish for AI augmentation. On our platform, what we see is actually 2 times the amount of AI skills required to do content creation today. So my point of view and just what I'm seeing today on the platform is that those jobs are actually evolving, not being substituted by AI. And again, I think we all live in an environment where we can tell where AI generated content is occurring.
Yeah.
And I think what we're actually seeing is a return back to, hey, let's make this not look so AI today.
All right, we have to leave it there, Callie. Really appreciate you taking time for us. Dr. Callie Monahan, Managing Director over at the Upwork Research Institute. Now, when we come back, we're going to talk about the uptick in deal making, specifically in Hollywood. But I want to turn your attention to Washington as we go to break. The President of the United States in the Oval Office right now, signing executive orders, making comments about the Pentagon Department, making comments about G20. We will continue to monitor those comments and, of course, bring you any news out of that as soon as we get it. You can also type Live Go on the Bloomberg terminal if you want to watch it yourself in real time. We'll be back in a moment. This is The Close on Bloomberg.
Rebrand will actually cost, and are there any concerns about, the Pentagon's mission of actually cutting back on spending?
Yeah, but not a lot. We know how to rebrand without having to go crazy. We don't have to recarve a mountain or anything. We're going to be doing it not in the most expensive. We're going to start changing the state.
We've been talking a lot about the uptick in deal making across the board over the last few months. Paramount Skydance in the entertainment space is one of the big ones. In fact, lately, today, we just learned that they're finding a new partner in Legendary Entertainment, inking a 3-year agreement to distribute films in theaters. That starts with the October 2026 release of Street Fighter. Now, that's the latest of Paramount's summer of deal making. First, of course, it had secured that 7-year deal for the rights to UFC, then unveiling new plans for a film based on Call of Duty franchise. It's keeping a lot of people busy in Hollywood. And quite frankly, if you're doing a deal in Hollywood for the last few years, there's pretty much been one person that you pick up the phone and call first. Tom Ara is a partner now at Weil's private equity practice, where he leads the firm's entertainment, sports, and media practice. Prior to that, he was at DLA as well as a few other firms and actually advised on Disney's acquisition of 21st Century's Fox Studios, as well as some of those TikTok deals. You've been a busy guy for years. And I'm curious if things are getting busier now, or you're expecting maybe an ebb or something in between?
Well, thanks for having me. Things are getting very busy. Obviously, it is an environment of consolidation, and change is constant. So that lives up to its name. But I think the key thing we're seeing is it's really about survival in a digital-first environment, right? Streaming dominates eyeballs at the moment, and it's not just scripted streaming. We've seen, the YouTube type content being dominant force as well.
What do those conversations look like? I mean, we kind of introduced you with the broader M&A, but I mean, you do a lot of work in kind of helping align the interests of, say, a Netflix with its creators or a Disney with its creators, et cetera, et cetera. I mean, what is that balance now?
They're very complex negotiations and discussions, because when you go into the streaming world, you're talking about a platform where it's all you can eat. It's consumption. There's no limit. You can watch the same show as many times as you want. unlike the good old days of having to pay for each view unless you bought the physical copy. So with the talent in the Hollywood community, the discussions are about how do we reward the talent and the creative community for that all-you-can-eat model. And so there have been some creative models that have developed over the years and continue to evolve on how to keep creators happy while the streaming giants and other content distributors continue to thrive.
Well, speaking of creators and talent, we were just having a really interesting conversation with Callie Monahan of Upwork about AI-generated content. And when it comes to potential discussions about potential deals, how much of a part of that conversation is AI?
AI is critical. It is going to be a critical part of the future of Hollywood and content. I think the important thing, and even when we talk about private equity clients who speak with us about the landscape, the important thing to understand is you have to navigate an existing system in Hollywood that are guilds, talent agreements, license agreements, and understand how those merge with AI and AI-driven content. And so if you're not very smart and particular about understanding those, you're going to find yourself on the wrong side of the law.
Were you involved at all in any of the union negotiations a couple of years, was it a year and a half or 2 years ago, where AI was sort of a big topic of at least what the union, the SAG-AFTRA, was actually trying to sort of get some clarity on?
We've absolutely advised a number of major and important clients throughout that process. And we have very good relationships with the guilds. We know the leaders of those guilds, and we speak with them frequently about the impacts. Look, it's a balance between innovation and protecting the rights of creators, the hard work of the creators. And I think ultimately what we like to do is find a balance.
How disparate right now is the industry with regards to all the different creators out there? I mean, we have so many sort of independents out there that maybe wouldn't have existed, or at least not existed at the scale that they are, 20 years ago. How much of that is a factor?
Well, I think the big shakeup, obviously, is the content creators that you find on YouTube and some of the other platforms who are not major studios, the Mr. Beasts of this world, who are entities and mini studios of their own. And that has really, I mean, the number of eyeballs, the number of people that can watch that content is just mind-blowing compared to a series that is, produced for millions of dollars on a streaming network, where that content is much less cost and much broader.
Is the compensation, though, commensurate with that? Because, I mean, you mentioned Mr. B. I mean, some of his videos are outdrawing, the number of people that watch the Super Bowl.
That's right. That's right. Well, I mean, there are different compensation models, obviously, for content distributed on some of those open platforms. Some of them are obviously advertising driven. Some of them are content and brand integration. And of course, he's been a very savvy business person who has made a lot of deals across, his own products. So the sky's the limit if you're savvy and clever about how you present yourself.
Yeah, it is wild. It feels like YouTubers are just eating everything when it comes to eyeballs. But speaking of eating everything, let's talk a little bit about private equity, because you're certainly seeing private equity enter the entertainment space, whether it's media, whether it's sports, the list goes on. And given the experience, the tenure that you've had in this deal-making space, I mean, how has private equity as a bigger player changed what you do?
Well, I think private equity represents what I view as a maturation of the industry, because private equity brings operational discipline together with growth capital. I mean, Hollywood has always been starving for cash. And whether it's been Wall Street or high net worth or Asia, there's always been the need for cash. It is a capital-intensive business. Making films is expensive, in the hundreds of millions now, and then marketing and distributing them. And having a private equity partner who can bring capital, but also operational acumen and diligence is important. And it will, I think, support a sustaining industry in a time that brings some uncertainty.
Yeah, deep pockets are a valuable thing. Tom, great to get some time with you.
Thank you.
Really
Pleasure to be here.
It. That is Tom Ara. He is partner at Weil's private equity practice and head of the firm's entertainment, sports, and media practice. Meanwhile, while Paramount bets on deal making to fuel future gains, Tesla's betting big on its CEO, Elon Musk. The company offering Musk an unprecedented pay package that could ultimately be worth around $1 trillion, aiming to incentivize him to drive Tesla's valuation north of $8.5 trillion over the next 10 years. Joining us now is Gautam Mukunda. He is lecturer of management practice at Yale's School of Management and also a Bloomberg opinion columnist. Great to get some time with you. You wrote in mid-August that billion-dollar CEO pay packages are disasters. How do you feel about trillion-dollar packages?
Well, no, that's completely different. They're great. No, seriously, let's think about this, because Elon Musk has just shy of $140 billion of equity in Tesla already, completely separate from the equity they're going to give him on top of that. So if he multiplies the value of Tesla by 8, which is about what he'd have to do to trigger this $1 trillion pay package to at least 8.5, so a little over 8, he would have $1 trillion in equity in Tesla already. So they're not giving him $1 trillion; they're giving him a second $1 trillion. So I don't know about you guys, but I can't think of anything that you can't buy with $1 trillion that you could buy with $2 trillion.
Well, the thing is, if the board is on board with it, if the shareholders are on board with it, I mean, what to do? Romain brought up the point earlier, and I think it's a good one, that yes, from a corporate governance standpoint, there are so many interesting ways to take this, but if just the reality is that he has a shareholder base and a board that is very much in favor of him, who is anyone to say no to that?
Look, Tesla at this point, one of its primary functions is to give my colleagues who study corporate governance heart attacks. Let's split this out, right? So one is, if you are invested in Tesla now, you are invested in Tesla because you believe in Elon Musk. You believe that he has done amazing things, which is true, and you believe that he will continue to do amazing things. And it doesn't make any sense to be invested in Tesla otherwise. So sure, like they probably are doing what the shareholders want. But I would also think that I do think the board in some sense is being strategic, because what they're signaling here, right, is the importance of self-driving cars, the importance of these robotics. But what they're really, really signaling is that Tesla's most important product isn't any of those things. Tesla's most important product is the legend of Elon Musk, because that's what people are buying into.
This gets to the idea, though, what exactly is the pay for? Or what should, or let me rephrase that, Gautam. What should it be for? Are you rewarding the CEO for what he or she has done? Or is this basically the carrot for the future to get them to do what you think they can do?
So it should be the carrot for the future, right? Like, what is the point of rewarding them for things that are already done? My objection to this is twofold. One is, he's already being rewarded for what he will do in the future. If he does the things that they're supposedly paying him to do, he will be a trillionaire. I mean, how is $2 trillionaire like $2 trillion sort of more of a reward than that? Aren't we, at some point you have to believe that there's a diminishing returns point here, and it's such that we don't need to transfer $1 trillion of shareholder wealth into the pockets of the CEO. But the second is, you can totally believe that Elon Musk has done incredible things in his career, which look, I'm never going to disagree with that statement. And also say that the Elon we're getting now maybe needs some governors, right? Needs some breaks, needs some people who are like, hey, Elon, maybe spend a little less time on Twitter, or maybe spend a little less time doing some other things. And that's the board's job. The board's job is to act like governors on the CEO. It's to act like people who sort of strengthen his best ideas and weaken his worst ideas. And this is not a board that's sending a signal that they're going to constrain the CEO. This is a board saying, we're going to give the CEO anything they want.
I am curious as to how much shareholders, meaning the non-controlling shareholders, can even push back on this. I mean, the first thing I saw this, and I'm glad you mentioned the first pay package, which was supposed to be basically $1 trillion and got ratcheted down to 20-something billion. But you look at some of the annual payouts that we've seen, including stock awards. Satya Nadella making, $80 million. Tim Cook making, $75 million. Jensen Huang, who is, of course, the superstar CEO, made a mere $50 million last year. And it gets to this idea that they all have market caps that are multiples right now higher than Tesla, So based on the structure of this agreement, as is laid out in the proxy statement, he would effectively have to get the market cap of Tesla above $8 trillion over the course of this in order to sort of reap all of those rewards. I am curious, at what point can shareholders say, on year 1, year 2, year 3, the progress isn't enough, can you claw it back?
Yeah, so, to get all of these triggers, to get these awards, he'd have to hit these triggers. So it's less of a clawback question than they just won't have materialized in the first place. But where I would say is, I mean, shareholders might also have a question of, suppose his behavior deteriorates, right? And there are certainly lots of criticism what does. Suppose Tesla sales continue to drop. Suppose they don't go sort of succeed with Optimus. And none of that is a crazy thing to believe, right? Tesla is not the leading robotics company. At that point, I think shareholders are going to have a pretty strong complaint about a board that has just that's kept shoveling money at its CEO and given him total license to act in ways that are not in their interest.
I asked this question to a guest earlier today, and I'm glad you point out this idea that there are other leaders in this space right now. So you're talking about paying this guy to catch up effectively. Yeah. Is there a case to be made to just take this company private? Given the current board structure, given the fact that Elon is Elon and he's going to do what he wants, why not take that $1 trillion, take this company private, and then he can do whatever the heck he wants with it?
Well, if he tweets out that he has funding guarantee, we'll know we have a bit of an adventure going.
X out, Gautam is not tweet anymore. He might come for you.
Oh, that right. Yeah. X is out. Is that what we call it? X is it out. Yeah, no, so Romain, here's the thing about that. Like, the logic that Tesla can do these things when they are not the leaders in any of these industries is basically, I think, that Elon Musk's magic powers, which again, SpaceX, the early years of Tesla, I'm not going to say they don't exist, are such that he can generate essentially infinite amounts of capital that he can pour into these industries that will make it work. If they're private, that equation gets a lot harder to work. So, I mean, I'm not kidding when I say Tesla's most important product is the legend of Elon Musk. It is what lets this flywheel. If you believe that this flywheel will spin, it is the only thing that will allow it to do so.
Yeah, and that's a good point. And I thought there were some interesting details in that proxy statement, Gautam, about how the board really was afraid that he was going to walk out the door, as one person at Bloomberg kind of described it, kind of a hostage or ransom situation. We got to leave it there, Gautam. Always a great conversation. Gautam Mukunda, lecturer of management, practice at Yale School of Management, also a Bloomberg Opinion columnist. We'll be back in a moment. This is Bloomberg. All right, welcome back to The Close. We're now going to talk about Press Juicery. Pleased to say that the CEO of that company, Justin Nedelman, joins us right now to talk a little bit more here about the business and about what's been going on. And Justin, I think the last time we spoke, we were talking a lot about what was going on in L.A. You also talked a lot about the company's expansion into the retail space. And since we last spoke, you actually made some big strides there, particularly when it comes to your presence in Costco.
Absolutely, yeah. We were tested in Costco on the West Coast, and we've been in and out of Costco for some time. But yeah, we went national with our wellness smoothie, and it's been a phenomenal success. And we're really, really happy about that partnership and kind of seeing those members really resonate with our offering. So it's been a really amazing journey, and we're all over the U.S. now.
I am curious about just how you ensure the freshness of the product. I think most of us who have gone to Press, we're used to going into your own physical stores. Is there a continuity in your supply chain to ensure that what I get at a Costco or Target or Sprouts or somewhere else is just as fresh as what I get from your store?
A great question. So we're fortunate to be vertically integrated. So we manufacture everything ourselves in California and are able to distribute that really efficiently to these partners like Costco and Sprouts and whatnot across the country. So because we manufacture ourselves, we can control the quality, and it's the same product you get in our store in LA as you get on the East Coast at a Costco.
And I want to talk a little bit about your product offering. Of course, Pressed, you think of juice, but smoothies as well. I know that you offer them. So what does the breakdown look like in terms of what consumers are gravitating towards?
So specifically in Costco, what we found is our guests, Costco members, are still craving fruit-forward smoothie, not just our hardcore green juices. But the difference really is the cold pressed versus like a pasteurized product, which is really what's out there as a competitor. And for us, we don't use anything unnatural. So no quote unquote natural flavors. Everything is pure fruit. And our competitors really can't offer that. So we're finding that these members in Costco just are really craving this category and in offerings that are more distinct like ours.
And when it comes to marketing, I can't believe I'm going to talk about Sydney Sweeney again, but in addition to jeans, of course, I also see her face on Buy Juice bottles, and I wonder how you approach that when it comes to marketing, partnering with celebrities and other brands.
Historically, we've really been more about the micro influencer and our guests being kind of the advocates for the brand. So we haven't historically paid for large celebrity endorsements. We find them using our products organically in posting, which is amazing. But we're always open to that. As of right now, again, it's mostly our members and the organic local influencers across the country that are like pursuing wellness, that some of these celebrities are following themselves. So we've kind of maintained that strategy. It's cost effective, but we're always open to ideas if it's the right partner.
I'm curious about your customer, Justin, and the complexion of that customer, particularly now on a day where we're talking to you, where we got a labor market report that seems to show that the economy might be fraying a little bit at the edges. What does that look like, a downturn in the economy for Press Juicery? Does it have an effect?
Interesting question. Press has been around 15 years this November, so it's been a relatively upward trajectory in the economy for that long. We're finding that we are still an accessible wellness brand. We're not so priced outside the market that it's a luxury item, and there's more expensive brands out there, especially your local juicery. So for us, we have not seen any negative pressure on sales. In fact, it's the opposite. Our stores are still comping positive, which is amazing. And in grocery, and what we're seeing in Costco, the guest is actually willing to pay more for a competitive product that has historically been in Costco that we're going head to head with. So as of now, I think this indulgent kind of wellness idea is not really the case with Press. But we're still quite accessible, I think, on a national basis for today.
All right, Justin, really appreciate your time on this Friday afternoon. That is Justin Nedelman. He is the CEO of Press Juicery. Now, still ahead, a big week for IPOs on deck. We'll discuss that and so much more coming up next. This is The Close on Bloomberg. Well, the U.S. IPO market set for the busiest week of the year so far, potentially seeing over $3 billion raised in total. Bloomberg's Bailey Lipschultz joins us now to discuss. So let's name some names here, Bailey. Of course, Klarna has to be at the top.
Klarna's at the top and should be the first out of the gate. Pricing Tuesday, trading Wednesday, hotly anticipated. It's been a long time coming. Katie, this is a company that we expected to go public back in April. Obviously, the tariffs put the IPO market on pause for a few weeks or months, depending how you want to look at it. But we will finally get that pricing to kick us off, and then that'll be followed by the likes of Figure in the blockchain space, the Winklevi, Gemini, a little bit for kind of every investor.
It'll be interesting to see what kind of traction that gets, particularly given it looks like the American Bitcoin debut that we had earlier this week fell a little bit flat here. What are some other names? I seem to remember reporting on Bloomberg that we might hear from StubHub, the ticket pricing service, and I'm told that an HVAC company might actually be the hottest trade in town.
Legions, yeah, HVAC, they focus on data centers, so that's Blackstone backed. That'll price, I believe, on Thursday trading
They should
Friday.
put that at the start of,
exactly.
of the prospectus.
That's what the people care about, is data centers or the AI flavor from that. But we are also, as you mentioned, reporting we're expecting StubHub to finally launch its process on Monday as is expected with Netscope, which will be a key test for the tech space. So certainly heating up across kind of industries and a little bit of, again, flavor for every IPO buyer, if you will.
Well, just quickly here, talk to us about potential demand. You think Legions, for example, I see that it's about 3 times oversubscribed.
It's a little bit lower than some of the others, but this is maybe a slower build. Again, when you have a private equity asset, you're dealing with leverage. You're not dealing with the kind of pent-up demand, knowing that a stock is probably going to pop 40 or 100% on the opening trade. So certainly a bit more of a sell there. BlackRock Coffee is the first consumer name we've seen really this year that I would say caters directly to consumers. That's another name that we've been monitoring demand from the buy side, but it's a lot of kind of how big are these orders, how real are these orders, and that's going to be something bankers are going to feel out next week.
All right, Bailey Lipschultz, who it looks like he's going to have a really busy week next week here. And I guess for all the deal makers out there, Katie, they like being busy. Several potential new entrants to the market coming down the pike.
No rest for the wicked.
All right, and we should point out that next week is going to be busy for the market's slew of economic data, including the PPI and CPI reports. We're also keeping an eye on what's going on here in the New York mayoral race, waiting for an announcement from current Mayor Eric Adams. And we're keeping an eye on Washington, the President of the United States, speaking right now in the Oval Office. The team at Balance of Power, they're coming up next at the top of the hour. They'll fill you in on what Trump has to say right here on Bloomberg.